Hello there, I hope that you are doing well. Welcome to this new lecture of the model series. During this lecture, I will be discussing points of interest with you. Methods to determine points of interest. The methods to determine the points of interest are exactly the same as the methods which I outlined during the previous lecture in which I explained the drawing query. However, there are some subtle things which I would like to share with you during this lecture which are very important to note. First of all, we will be looking at PD arrays as points of interest. Secondly, we will be paying attention to time cycles as points of interest. And thirdly, we will be paying attention to key levels as points of interest. Now, before we dive into this lecture, I would like to share with you that it's very important that you have gone through the previous lectures and that you have studied them in depth. The reason why is because there's a sequence in which I'm explaining everything within this model series. If you are not following the sequence and you're simply just picking these lectures from lecture 1 to lecture 5 and then you go to lecture 2 or lecture 4, right? And then lecture 3, the whole sequence is disrupted. Meaning you need to make sure that you watch this series in the right order because I'm explaining everything in a specific order. Now, what we will focus on during this lecture is the following. We will be focusing on determining point A. On the left right here, on the bottom left within a by program and on the top left within a cell program. Point A is inception of the new program, whether it be a by program towards the upside or a cell program towards the downside. By utilizing points of interest, we're able to anticipate where point A will form, meaning where we're likely going to see the smart money reversal form. Point B represents the drawing query. That's the terminus. That's the end of our basically anticipated program, whether it be buy or sell program. And that is where we begin with determining point B, with determining the drawing query, and then we look at where the point of interest is. When we pay attention to PD arrays, I have shared the schematic which you see in front of you prior during the series as well. I'm just going to walk you through it quickly again. What I would like you to see is that in front of you can see the PD arrays matrix. This PD array matrix was created by the Inner Circle trader. Full credit goes out to him. And he basically shared this sequence in which all the price patterns which he has scored are presented. Meaning what you can see is that inside of any given dealing range, what you can see is that there's a premium side and a discount side. Below 50% is discount and above 50% is premium. What you can see is that inside of both the premium as the discount, his price patterns are forming. Whether it be, for example, the rejection block, whether it be the bearish order block, whether it be the fair value gap, the liquidity void, bearish breaker or bearish mitigation block, and the same for the discount arrays, but then in the opposing order. Now, when it comes to these arrays, it's important to note that we can blend these with time cycles and key levels to basically anticipate where swing points are going to form. And that is what I will teach you during this lecture. When we pay attention to an example of this taking place, what you could see is that on the left you can see a higher time frame chart of any given market, and on the right you can see the lower time frames. What I would like you to see is that on this higher time frame chart, what you see is that the market expanded towards the upside and it retraced lower. What did the market retrace into? The market retraced into a bullish fair value gap which formed throughout this expansion higher. What happens throughout this retracement lower is that sellers are being trapped into believing lower prices are next. Meaning a lot of sellers who look to go short place a stop loss above this high because they believe the high is in. What will the market be repriced into? It will be repriced into this old area of inefficiency, fill in the imbalance, so that the market is then allowed to expand towards the upside. What it looks like on the lower time frames is the following. On the lower time frames, it means that we're seeing a market make a buy model. Original consolidation, sells it off the curve into that higher time frame imbalance, followed by the right side of the curve. Now, when you pay attention to this framework right here, it's important to note that this is all fractal, meaning, as you can see, I haven't put in any time frames. I've not put in, oh, this is an hourly chart, this is a 1 minute chart. No, why not? Because on the left it could be a monthly chart and on the right it could be a daily chart. What I would like you to see is that I didn't put in a specific time frame for the higher time frame and the lower time frame. And the reason why is because everything is fractal. And therefore what you must note is that regardless of what time frame you're looking at, as long as you know what a higher time frame is and a lower time frame, you can anticipate where these swing formations are going to take place. And once you can anticipate that we're going to form a low inside that imbalance, what you can then look for is on the lower time frames for the sign of that market maker buy model to step in. When we pay attention to a chart example of this, what you can see is that on the left you can see a market which expanded towards the upside, and we then saw this large imbalance get created. Notice that the market retraced into that imbalance, and notice how we just stepped into the imbalance and immediately expanded towards the upside. What I would like you to see is that inside the delivery from this high to this low, to the moment that we tapped above the high right here, you see a lower time frame market maker buy model. That's what you see on the right, where I see the south of the curve, which is very choppy, and then you see the market eventually turn around and draw towards the upside. This is the right side of the curve. Notice that we traded into that imbalance right here. We initially formed the low inside of there, we retrace higher, have one more push towards the downside, and then the market begins to accelerate towards the upside. And from that moment in time, the buy program is taking place. Higher time frame expansion, followed by a retracement, followed by an expansion, is a lower time frame market maker model. Keep that in mind. When we pay attention to another example then, what you can see is that on the left you can see the schematic of a bullish breaker, where you can see that the market expanded towards the downside, it ran up higher, it retraced higher, and we then saw one more leg towards the downside taking place. Notice that the market displaced above the high, which set up that final run lower taking place. Now what's important to note here is that the final run lower has to be in some form of point of interest, but that's something which we'll discuss way later within this model series. Notice that the market retraces into the price range of that bullish breaker, and we then see the market eventually expand towards the upside. Inside of the fractal of this retracement lower, followed by this expansion higher, you will see a lower time frame market maker buy model as you can see on the right. Why? Because inside of this retracement lower, what's taking place is that sellers are being trapped into believing that we're going to see lower prices next. Meaning, a lot of sellers are being induced into the marketplace. What IPDA will seek to do is that it will seek to reprice back into the price range of this bullish breaker, so that smart money is being given the opportunity to buy and position themselves long inside of the price range. That is why on the lower time frames you will see the sell side of the curve, followed by the buy side of the curve. Where will the buy side of the curve originate from? The buy side of the curve will originate from the price range of that bullish breaker. Now what you can also investigate is whether or not this bullish break on the higher time frames is going to be paired with imbalances throughout this repricing higher. Usually there's at least one or maybe even two imbalances which form throughout this repricing higher. Even when you look at the left side of the curve when we were dropping towards the downside, then you will see the market structure shift pattern as you know it. It's important to note that the expansion, retracement, expansion is a lower time frame market maker buy model. And you're probably going to hear me say that more often throughout this lecture, so buckle up for that. Here we can see a chart example of this. What you can see is that the market expanded towards the upside right here on the left, and we then saw the market drop towards the downside suddenly. Notice that the market took out an old low, shown by this horizontal line right here, and we see the market eventually form a new low. The market displaces towards the upside, and we see it reprice above this high right here. What I would like you to see is that we see the market form imbalances throughout this repricing higher. We see the market retrace and then have one more push towards the upside. Notice that the market eventually drops towards the downside, trading into this old high, and then the market expands higher. What I would like you to see is that as you've been taught to look at bullish breakers, you've been taught to look at the final up-close candle before the sudden drop lower to be the bullish breaker. However, what I'm about to share with you based upon what you can see in front of you is going to be something to think about. And the reason why I'm discussing this now is because I want to hide this within this model series. What I would like you to think about, right, is the following. What I would like you to think about is why is it the final up-close candle? If you would purely look for the final upclose candle, you would say, hey, the bullish break is down here, this big upclose candle. However, what I would like you to understand is that the price range from this high right here to this low is an imbalanced price range. And that means if they will seek to retrace back into this high, so that price can be delivered in an efficient manner. That means that we can anticipate the retracement into that, followed by an expansion higher. But what is present here on even a lower time frame than this current time frame? Well, inside of this long wick, you will see that there are upclose candles inside of this high formation. And therefore, what I would like you to begin investigating is balanced price ranges more in depth. Notice that the market drops into the price range of that high, into this imbalance, and we then see the market expand towards the upside. On the lower time frames on the right here, what you can see is that the market expanded lower, reached that price level of that high, we tapped it, retraced higher, and then we saw the market have one more sudden drop before it began expanding towards the upside, drawing towards buy side liquidity, resting above the high of the retracement. Sell side of the curve, buy side of the curve. The next factor which we're going to take a look at is the bullish rejection block. This looks like the following, where you see the market expand towards the downside, and eventually you'll see a low formation taking place. Inside of this low formation, you will see that there's a very long wick which will form. This wick will be extended to the right. And the reason why is because this wick is your bullish rejection block. We see the market expand towards the upside and we see it deliver higher. Throughout this delivery higher, what you can see is that the market hasn't retraced yet into the level of that bullish rejection block, into this red line. Therefore, what you can anticipate is that at one moment in time, the market is going to drop into that bullish rejection block. And when the market drops into this bullish rejection block, you can be looking for the signatures of a market maker buy model unfolding. Why? Well, the market expanded towards the downside into a point of interest and then it expanded higher. So what you can see is that the sell side of the curve got delivered, followed by the buy side of the curve. But within a bigger fractal from this low to this high, you can see that this is merely a retracement followed by an expansion higher. But when you look at it from a market maker model perspective, what you can see is that the sell side of the curve is being delivered into that bullish rejection block, followed by the right side of the curve right here. Now, what is important to note is that when it comes to the rejection block and the market maker buy model, which will originate from it, is the following. Intermarket relationship plays a crucial role when determining what rejection blocks are likely going to hold. Because what the other market is likely going to do is it's likely going to take out this low, forming SMT, which we'll get to later within this model series. When we pay attention to a chart example of this, what you can see is that on this chart, what you can see is that the market expanded towards the upside and we saw a retracement taking place. Notice that the market traded into the price range of this very long wick, which set up the expansion higher. Notice that we have this large down close candle and notice that we have a very large wick right here. I'm annotating the close of this down close candle. The range between close to low is the bullish rejection block. Notice that the market expands higher again and we eventually see the market drop all the way down into the price range of that bullish rejection block. We take out sell side liquidity engineered below this low and we eventually see the market expand higher with this big up close candle. Notice that the market reprices higher towards this high. When we pay attention to the lower time frame fractal, what you can see is that the market expanded towards the downside right here. Consolidation takes place. The market expands lower once more and we see time distortion take place, where the market is simply waiting. It's waiting for the right time before that buy program is allowed to take place. Notice that the market goes sideways around the price level of the high of that rejection block and eventually we see displacement towards the upside. Notice that the market trades above the high, which set up that final run lower into the point of interest of that bullish rejection block. Imbalance gets created and we see the market retrace into that IOFET, institutional order flow entry drill, and the market expands towards the upside, drawing towards this buy side liquidity pool right here. Again, when it comes to looking at bullish rejection blocks, pay attention to intermarket relationship. When we pay attention to the bearish examples then, what you can see is that the market expanded towards the downside on the higher time frames, a retracement higher takes place, and we then see the market expand towards the downside once more. On the lower time frames, this looks like a market maker sell model, where I can see that the market expanded towards the upside, this is the buy side of the curve, and eventually it reaches the price level of that fair value gap based on the higher time frames. Notice that the market then expands towards the downside and it's drawn towards sell-side liquidity engineered below this low. A higher time frame expansion followed by a retracement is a lower time frame market maker model. Because it's a bearish expansion followed by a retracement higher followed by a bearish expansion, in this case it's a market maker sell model. In what does the retracement stop? The retracement stops inside of a bearish fair value gap which will have formed throughout the expansion lower. When we pay attention to a chart example of this, you can see the following. You can see that the market expanded towards the downside with this large downward candle, and we see this CB get created. Notice that the market retraces above 50% of that CB, and eventually we see the market draw towards the downside. When we pay attention to the lower time frame fractal, what you can see is that the market expanded towards the upside and it was in a rush to reprice higher. Notice that the market eventually forms a swing high inside the price range of that bearish fair value gap of that CB, and the market begins to displace away from it. Notice that it begins to reprice towards the downside. What is the market drawn towards? Well, the market is drawn towards sell-side liquidity resting below this low. Now we will discuss market maker models more in depth later, and for now we're simply going to focus on inception of these market maker models, and that is hopefully what you're beginning to see, where we can utilize a specific method for determining our draws on liquidity. We can utilize that same method for also determining our points of interest, and these methods are the same, meaning the same process applies for determining your draw on liquidity as it does for your point of interest. The variables are the same because every single entry is someone else's exit. Every single exit will be someone else's entry. And that is one of the most fascinating things which you can see on the mentorship form, where you can literally see students just go back and forth, buy, sell, buy, etc. over and over again. It's almost as if we're handing over positions to each other. And some of you are probably smiling because you have experienced that probably with me, where I would have taken a trade and you then took the opposing side of that trade later. Meaning I initially went long, targeted an old high. When the market reached that high, it turned around and you went short. And that is what we refer to as playing ping pong. And it's one of the most beautiful things to see because it shows you that there are plenty of opportunities when you understand both draw on liquidity selection as point of interest selection. When we pay attention to the bearish breaker then, what you can see is that the market expands towards the upside and it forms this high. We then see this sudden drop lower taking place. The market has one more expansion towards the upside before it rolls over. Notice that the market takes out the low, which set up that final run higher. We then see a retracement taking place into the price range of that low, and the market then expands towards the downside. On the lower time frames, this is going to be your market maker sell model, where I see the buy side of the curve and the market is being repriced into the price range of that bearish breaker, followed by the sell side of the curve, where the market is being repriced towards the low of this original consolidation, which is the low which set up that retracement higher. Now when we pay attention to the higher time frames, it's important to note that this range right here is your bearish breaker, and when we pay attention to the lower time frames, you will see that inside that retracement higher, followed by the expansion lower, there's going to be a lower time frame market maker sell model. Now as outlined within the bullish examples as well, pay attention to whether or not a fair value gap will get created throughout this run towards the downside. And pay attention whether or not there's also a fair value gap on the left side right here. Because if you see those fair value gaps paired with this breaker, then you can anticipate that we're likely going to see a strong rejection of that area, because that is my market structure shift pattern. When we pay attention to a chart example then, what you can see is that the market expanded towards the downside. We saw the market retrace higher and it formed one more expansion leg towards the downside. A low forms and the market expands higher. We see the market consolidate, time distortion is taking place, And eventually it drops towards the downside aggressively with speed and velocity. Notice that the market is drawn towards this low and eventually expands beyond it. Notice that this low right here is the low of an imbalanced price range. Why? Because what you can see is that we displaced through that low with this CB. And therefore what you can anticipate is that the market is going to retrace into that level, balance out the price range by offering buy side, so that the market can then continue towards the downside. And you might be wondering, balanced price ranges, what do you mean? You haven't explained that yet. What I would like you to start thinking about is why PD arrays work in the first place. When you start thinking about why PD arrays work in the first place, you become to realize that it's all to do with balancing out of specific ranges. And that is what we refer to as balanced price ranges. In this case, what you see is that south of the curve takes place, where you can see that the market is repriced towards the downside. And what's happening throughout this south of the curve is that sell side is being delivered. When we then see the market run up higher, we see the buy side of the curve being delivered. However, what's important to note is that we're not referring to a market maker sell or market maker buy model now in the sense of the traditional market maker model factors as you know them. No, we're simply looking at delivery functions, where you have two functions of delivery, either sell side or buy side. And what you see is that the market delivers sell side, buy side, and eventually it offers sell side through this low right here with this CB. And therefore what you can anticipate is that the market has to offer buy side into that again. Why? Because we saw twice sell side delivery and we saw once buy side delivery. Let me repeat that. Sell side, buy side, sell side. You might be wondering, why are you skipping through all of this delivery for accounting purposes? Because this is all time distortion. It's a relevant price action. Notice that the market displaces through that low with that CB. We retrace higher into that old low. Buys is being delivered. And notice how the market keeps on rejecting that old low. This is why breakers works, guys. It is all a result of understanding balanced price ranges. And yes, I promise that I will discuss them more in depth later within this model series. Now what we see on the lower time frames then is that the market expanded towards that red line, which represents that old low. And we then see time distortion taking place, where the market is simply consolidating and it's waiting. Notice how every single time that it reaches that red line is rejecting it. Eventually the market displaces below this down close candle, and we see the market begin repricing towards sell side creatively resting below these relative weak lows. Original consolidation, buy side of the curve followed by the sell side of the curve. When we pay attention to the bearish rejection block then, what you can see is that the market expanded towards the upside and eventually forms this high right here. Notice that the market then reprices towards the downside quickly. What's important to note is that inside of this swing high formation, a high with a very long wick will have formed. What we pay attention to is the range of that wick and we extend it to the right. The reason why is because this is our bearish rejection block. We see the market consolidate for a while and eventually it has one more push towards the upside right here. It's inside of this repricing higher that the market is being driven towards that reference point of that rejection block. So what is taking place is that buyers are being trapped into believing higher prices are next, so that smart money can look to go short, meaning we need willing buyers that we can short against. What we see is that the market runs up higher and it then expands towards the downside quickly. Let us now pay attention to the bearish rejection block. What you can see is that the market expanded towards the upside and eventually formed a swing high. It's inside of this swing high formation that there will be a long wick which will extend to the right. Notice that the market repriced towards the downside and we eventually see it go sideways for a bit. The market has one more push towards the upside then into the price range of that bearish rejection block, and we then see the market expand towards the downside after forming a new high right here. Now what's important to note is that when it comes to looking at the reaction to this bearish rejection block, intermarket relationship plays a crucial role. What you can see on the lower time frames is that the market expands into the price level of that bearish rejection block, forms the smart money reversal there, and then the sell side of the curve unfolds. This is a lower time frame market maker sell model inside of this fractal where the market expands towards the upside, drawing towards that bearish rejection block, followed by a reversal lower. While we pay attention to a chart example of this, what you can see is that the market expanded higher, formed a high. Do you see this going wick? I'm extending that to the right. Notice that the market drops towards the downside, and we then see the market form a new low before the market reprices higher. Notice that consolidation is taking place in advance of that rejection block. The market expands higher, drawing towards the low of that bearish rejection block. And notice that the market takes out buy-side liquidity resting above this high. And we see the market eventually roll over. What is taking place here? Well, inside of this final run higher, followed by this reversal, followed by the sudden down close candle right here, you will see a lower time frame market make a sell model. When you pay attention to the lower time frame chart on the right, what you can see is that the market consolidates for a bit, and it slowly began expanding towards the upside. Then speed and velocity got induced into the marketplace, where the market began expanding higher quickly. Notice that we engineer buy-side liquidity right here, and we then see the market drop towards the downside. Notice that more relative weak lows are being created, and the market then runs up higher, drawing towards the low of that bearish rejection block. Notice that the market is in a rush to reprice higher. Eventually, it reaches the price level of the low of that bearish rejection block, and we then see the market begin rolling over. Buy side of the curve, sell side of the curve. What is the market drawn towards? It is drawn towards sell side liquidity, resting below the lows, which set up that repricing higher into the point of interest taking place. Notice that from there, the premium array matrix forms on the right side of the curve beautifully. The next method of determining points of interest, which we're going to take a look at, are time cycles. When it comes to time cycles, it's important to note that you have watched the prior lecture on the topic in which I outlined what time cycles exactly are. If you did not watch that lecture yet, I highly suggest you to stop watching this lecture and go back to that previous lecture. When it comes to time cycles, it's important to note that we have a specific high, which is represented by this green line, and a low, which is represented by this red line. These highs and lows will form during specific windows of time. When it comes to time cycles, it's important to note that time cycles, their highs and lows, are dynamic. You might be wondering, dynamic, what does that mean? Well, that means that the time cycle high and lows change for any particular time cycle as time progresses. Meaning, if we are paying attention to the following chart example, this could be Monday's morning session, where the high of the morning session formed right here at this price level, and the low of the morning session formed right here at this price level. And notice that I've not written out what these levels are, because you can just put in any number, doesn't matter. What I'm about to share with you is why these highs and lows are dynamic. When we pay attention to the next day, Tuesday's morning session, you can see that the high and low of that morning session have changed, meaning both levels have moved towards the upside. You might be like, what is the significance of this? Well, the significance of this is that you can see that the engineering of liquidity is taking place around different levels, and keep this in mind moving forward. What we'll be looking for when it comes to time cycles is mainly the following. We will be looking at a purge and revert taking place, where if bullish, we are going to look for an open low, where the market is going to open low, taking out sell-side liquidity, resting below the previous cycle low, followed by reversal higher to draw towards the previous cycle high. This takes place in bullish markets. If we pay attention to a bearish example where we're anticipating lower prices, we'll be looking at open high, where the market will seek to open up, run up higher, taking out buy-side liquidity resting above the previous cycle high, followed by a reversal towards the downside, drawing towards the previous cycle low. It's in this process where the market takes out that previous cycle high or that previous cycle low that you must understand that this is manipulation which is taking place, where the final manipulation leg is taking place before the reversal will unfold. Now, this is the most important framework to understand when it comes to time cycles, because time cycles represent fixed windows of time in which highs and lows will form. When you start paying attention to these highs and lows and you start extending them to the right on your charts, you'll be able to gauge the order flow in a very objective manner. When you pay attention to a chart example, what you can see is that I've annotated the previous PM session low and the previous PM session high right here. Note that the market expanded higher throughout this afternoon session. We then saw the Asia session consolidate right here, and we saw London open up. London runs higher initially, but notice that it just falls short of the high of Asia. Meaning, instead we see more buys would be engineered above these highs right here. We then see the market drop towards the downside, and we see it drop below the Asia session low, which is this low. And we see it drop below the previous afternoon session low, the previous PM session low. Eventually the market forms a low here during London, and the market begins to expand towards the upside. What is it referring to? Well, first of all, it is referring to the buy side liquidity engineered above these highs right here as a first objective. And secondly, what it's referring to is the previous PM session high, where you can see that we opened low for the afternoon session, and we then saw the market take out a previous cycle low, in this case a previous PM session low, and we then saw a revert taking place towards the upside, drawing towards that previous PM session high. Purge and revert. When we pay attention to key levels, however, what I would like you to understand is that key levels are fixed. The next chart example which we're going to look at is the following, where you can see that throughout the green box the market initially consolidated, and we then saw the market begin to reprice towards the upside quickly. Notice that eventually it began to slow down and it began to have a grind towards the upside, where you can see it's just going back and forth, slowly grinding towards the upside. Notice that eventually the high of the green box forms, and the green box is representing a 30-minute cycle for your info. I'm just referring to the green box so that you can visually see it. And the reason why is because of the following. These time cycles are basically the same across all different time cycles, meaning across the bigger time cycles, across the smaller time cycles. The logic is always the same. So as long as you know that these boxes represent time cycles, you can analyze why the market opened up higher throughout the next blue box, took out the previous cycle high, and then reverted towards the downside. Why? Because you understand that we are seeing an open high, taking out the previous 30-minute cycle high in this case, followed by a reversal drawing towards where? The market is drawn towards sell-side liquidity engineered throughout that previous cycle. Where is the sell-side liquidity engineered? It's engineered below the previous cycle low, below the previous 30-minute cycle low, which was the low of that original consolidation. And this is what's important to note. These market maker models are not simply price patterns. They're not price patterns that you just put on your chart and that's it. No, what you must understand is the logic behind inception to terminus. And that right there is where the true light bulb moments will take place. Now that we have discussed time cycles, we're going to be discussing key levels. When it comes to key levels, you must note that key levels are fixed. And the reason why I'm mentioning this is due to the following. The reason why I'm mentioning this is because key levels are fixed levels, whereas the time cycles, their highs and lows, are dynamic. The time cycles, their highs and lows change, meaning their price goes up and down. However, when it comes to these key levels, they remain the same regardless of what price did in the past, or regardless of what new time cycle is opening. It doesn't change, meaning we always have a specific range in which we have 4 quadrants. That is a very important insight which I want you to keep in mind, because there's a big difference between key levels and time cycle highs and lows. I would like you to think about the following question. When do key levels become significant? If you would like to pause the lecture to have a good thought about it, I really suggest you to do so. And the reason why is because that way you're able to think before I provide you with the answer. And I know that the majority of you are probably not going to pause the lecture. You're probably already skipping ahead. But yeah. In order for you to have crazy light bulb moments, you must be able to think for yourself and then compare that to how I'm about to explain it to you. Key levels become significant when they get blended with the element of time. It's time then price, meaning time without price means nothing, just as price without time means nothing. But when we blend the two elements, that is when we can anticipate what's likely going to happen next. When we pay attention to an example of this, what you can see is that I have put on time cycles and key levels. What you can see is that we see the market expand higher, originating from the 20,900 price level, which you can see right here. Notice that the market is repricing towards the upside and eventually it forms a high. This high gets formed right here. Notice that the high forms in advance of the 21,000 price level, which is our key level. We see the market then open up the new time cycle, represented by this vertical line, and notice that the market reprices higher. We see open high taking place, where the market takes out buy-side liquidity resting above this previous cycle high, and it reaches that key level which we are monitoring. But how do we know that this is our key level? Well, based upon those mathematical calculations, we already know that this is a key level no matter what. But what tells us that we're likely going to see clean delivery taking place afterwards is when we see buy side being engineered in advance of it. And that is how you can utilize the time cycles and the key levels to anticipate market swings. Meaning, what you can see is that open high takes place where that previous cycle high gets taken out. By itself, that's already a point of interest. However, when you start blending that with these key levels, you begin to become able to anticipate when and where swings are likely going to form. And next at what you could be looking at is, for example, a higher time frame array, which would have formed in the past. Think about PD arrays. We then see the smart money reversal taking place, and the market is displacing towards the downside. Notice how the market is being repriced lower, and it's drawn towards the 20,900 price level. Now, what is important to note is that when it comes to this delivery lower, what you will see is that premium arrays will get created, meaning the market will displace towards the downside and imbalances and such will get created. It's inside of these premium arrays that shorting opportunities will present themselves. However, what I would like you to investigate is where these PD arrays are forming. Think about these key levels. Let's take a look at the chart example. Here we are at the market of gold, and what you can see is that I've plotted the current range. The range that price was in was from 2,700 to 2,675. Notice that I'm utilizing this quadrant right here of 75% of the bigger range of 2,700 to 2,600. I'm utilizing the 75 level as the range where we're currently in between 75 and 100. The reason why is because these quadrants themselves also are particular ranges, because inside of these ranges you're also going to see that there's a equilibrium level. There's also going to be a 50% level. And what you can see is that equilibrium of this range is right here at 2,687.5. Now, what's important to note here is that what you can see is that this might seem like a pretty random level when it comes to what the price is, since it's not a full 100 number. However, what you must understand is that in any given range which you're monitoring, there's always an equilibrium level. And equilibrium by itself can also function as a rejection level. So the next time when you start looking at these liquidity pools which are engineered, pay attention to whether or not it's in close proximity to equilibrium of a bigger range. Ideally, you would like to always see it be at a full 100 number. However, sometimes what you must see is that the market will form that higher low in advance of either equilibrium of any given range or even a quadrant. And that is what I'm about to show to you. What I would like you to see is that throughout AMA, this blue shaded box, the high forms right here in advance of equilibrium of this range. And notice that the low forms in advance of the range low, in advance of the 75 level. Notice that the market runs up higher then, and comes in very close proximity to that equilibrium level. Notice, however, that a new time cycle opens up and the market opens high, and we then see the market drop towards the downside. Why or why does this occur? The reason why is due to the following. We open high, take out buy-side liquidity resting above the previous cycle high. We reach equilibrium of that bigger range which we're in. Notice that we just go above it and we then reprice towards the downside heavily. We reject it. Why does this occur? The reason why this occurs is due to the following. What happened was that liquidity was engineered in advance of equilibrium right here, but also in advance of the range low right here. And therefore what you can expect is that the market is likely going to reject equilibrium and draw towards the downside. Why? Because this is perfect engineered sell side. Run the high, run the low. So what I'm looking for actively when I come to the charts is I'm looking for liquidity to be engineered. When does liquidity get engineered? Through time. And that is why we blend both these time cycles with these key levels. We're now going to be paying attention to the bullish example of the time cycles and the key levels. What I would like you to see is that this example is exactly inversed from what we looked at within the bearish example. However, what you can see is that we're now looking at different prices right here, where I can see that we're looking at 105 and 106 to be a range low and range high. When we pay attention to the bullish example, the most important thing to understand is open low. Keep that in mind. What we see is that the market expands towards the downside right here, and the market is in a rush to reprice lower. Notice that we eventually form a low, and the market then retraces higher. What is happening right here? Well, what's happening is that sell-side liquidity is being engineered below this low. When do we retrace higher? When a new time cycle opens up. So what's happening here is that people are being led to believing that the low is in and it's now time to run up higher. However, the market has yet to reach the key level of 105, meaning it has yet to reach this price level where the low should form after taking out a key time-based liquidity pool. Meaning in advance of a key level, you can see that time-based liquidity has been engineered right here. So what we will look to see take place is the market to drop lower to take out the previous cycle low, reach this red line right here, and from there we will be monitoring whether or not a buy program is going to unfold. All throughout this delivery on the left, you can see that the market is drawn towards the downside. But eventually, once the signs become present of a low formation taking place, that is when we can anticipate that the right side of the curve is going to take place. What is the market drawn towards? The market is drawn towards buy-side liquidity engineered throughout the previous cycles, so throughout the highs which will form throughout the previous cycles, and it will reach price towards of the highs which have been engineered in advance of these key levels. Now again, keep in mind that when it comes to these key levels, it's important that you blend them with the time cycles, meaning pay attention to where a previous cycle low is within a bullish example, and pay attention to what key level is near. The reaction to that key level will be very telling, because if price would not show the signs of forming a low at this level and will just displace through it, then we're likely going to see further continuation lower taking place, and then you will not see the reversal taking place. However, when you see the signs of the reversal taking place below that previous cycle low, whilst you're bullish on the higher time frames, that is when we can look for our buying opportunities to present themselves afterwards. When we pay attention to a chart example then, what you can see is that the market expanded to the downside right here, and notice that we eventually form a low right here. We then see a new time cycle opens up, and the market is just consolidating around 20,450. Notice that eventually we see the market run up higher, forming the high of this time cycle, and we then see the market drop towards the downside. Notice that the market takes out sell-side liquidity resting below that previous cycle low, and we then see a retracement higher taking place back into the 20,450 price level. Do you see how the market rejects this level right here? We then see this sudden drop towards the downside, and notice that that drop gets completed when the new time cycle opens up with this green shaded box. Why is this important? Because what's important to note is that in advance of the 20,425 price level, what you can see is that the market formed this low. Therefore, sell-side liquidity has been engineered in advance of that level. When the new time cycle then opens up and drops lower immediately, that is a purge of sell-side liquidity, which could potentially be in play. However, what confirms to us that this is a purge of sell-side liquidity and not just a sweep to continue lower is when we displace higher. It's a very important understanding to have. There's a difference between the word use in terminology of sweeping liquidity and purging liquidity. Sweeping liquidity is when the market takes out a key liquidity pool, and from that moment in time, we have swept the liquidity. However, what confirms to us that this sweep is in fact a purge of liquidity is when we see the market begin displacing higher, because it shows to you that liquidity has been purged and that smart money has now positioned themselves long. What is important to note when it comes to these key levels is that they are not always going to be respected to the tick perfectly, meaning sometimes you must allow for the market to simply move beyond them a bit. Meaning, when the market just goes below this horizontal line, which represents the 20,425 price level, you're not thinking to yourself, okay, it's going to continue dropping, it's going to continue dumping. No, you're still anticipating that low formation to take place. These key levels are here to provide you with structure behind your analysis. Same with these time cycles, highs and lows. And the reaction to them will be very telling. So what you see is that we open low for this new time cycle, purge sell-side liquidity, reach this key level, and eventually we see the market displace towards the upside. Do you see where this imbalance forms? Throughout the repricing through that key level. Imbalance forms, market retraces into that buying opportunity, and then the market expands towards the upside. Whilst the market runs towards, first of all, it's run towards that 20,450 price level and the buy side liquidity which is engineered around that. So for example, this previous cycle high, purge previous cycle low, refer towards previous cycle high, and eventually we see the market run up even higher, drawing towards that 20,475 price level. Do you see how the market retraced into this very large imbalance right here? This imbalance got created whilst we repriced into that 20,450 price level. This is equilibrium of the bigger range, by the way. Market retraces into that, and as long as that does not get displaced below, you're still anticipating continuation higher. Market forms a new low here, and what do you note? Hey, expansion higher, followed by retracement lower, followed by expansion higher. So what will be present right here? This will be a lower time frame market maker buy model. Do you see how I just blended everything with each other? This whole lecture? Yep. Beautiful, isn't it? We see the market expand towards the upside and it's drawn towards the 20,475 price level. And that is the trade idea done. Summary. What I want you to investigate is I want you to investigate the following. I want you to investigate liquidity being engineered in advance of key levels. When you start paying attention to the higher time frame PD arrays as well, that are in close proximity to these levels, you'll begin to see repeating signatures there. And that's something which I'm going to give to you as a homework assignment as well. As a homework assignment, what I would like you to do is I would like you to find 15 examples of price reaching a point of interest based upon either a higher time frame PD array, time cycle, or key level, and price rejecting it. Meaning, I would like you to begin training based upon a higher time frame chart, your ability to recognize what points of interest are. Once you're able to recognize what points of interest are and you're able to see these rejections taking place, you must understand that on the lower time frames, market maker models will present themselves. I want you to log both the higher time frame as the lower time frame chart. Meaning, I want you to save both a screenshot of the higher time frame as the lower time frame chart. So for example, an hourly and a 1 minute chart. And would like you to annotate them as in-depth as possible. Meaning, be sure to fill in all of the blank areas on your chart with text or with symbols, etc. Showing what you're seeing within the markets. Keep in mind, blending the different elements leads to more significant POI selection. And that is what I would like to end this lecture with. Meaning, your focus should be on blending all of these different elements which I have outlined to you during this lecture when it comes to points of interest selection. Because once you start blending all these different elements, you will see exactly where these turning points are forming. And that is something which you can only find out by investigating on your own. So now it's time for you to go into the charts and investigate what I outlined to you. I want you to go into the charts with an open mind, and I want you to investigate everything which I explained to you during this lecture. I want to thank you for watching this lecture all the way to the end. Good luck with your studies, and I look forward to speaking to you in the next one. Be safe.